So like technical analysis is kind of like counting cards, right? But going back to Little Rocky, right? Does he use iPhone?
Yes.
All right,
So-
fam, let's go. We're getting ready to start. I mean, we're still live, but
Okay.
now just to let you all know that the camera mics, so you all speak up.
Okay, now is it recording?
Yes,
Or
they're
are we getting-
recording.
we getting footage?
Yeah, we're still
Okay.
recording.
All right, so
Well, I
go.
left real quick, so I'm not even, okay, no, not a screen like that. No Ralphie.
Okay, so Little Rocky, right? So he uses iPhone.
Correct.
Does he have a MacBook Pro?
He does not, no.
I have an assistant.
Yes, he has MacBook.
Okay, so they're using Apple products, right? They could purchase Apple stock like right now
1,000%.
at 13 or 15 years old,
Mhm.
and they could hold on to it until they're your age.
Mhm.
If they do that, right, I wouldn't treat the purchase of Apple stock as gambling. They bought a stock ownership in a company that's providing a product to them that they think is a valuable product.
Right.
Right, and so if they bought it, right, and held on to it, right, that's not gambling.
Is it a possibility that 20 years from now Apple could go under?
Is it a possibility? It is a possibility.
Of course.
Okay, I mean, your idea of gambling is, again, I mean, Elon Musk gambled when he started Tesla, right? I mean, if that's what you're saying.
No, it's not the same thing in that sense because.
No, because when he started Tesla, right, there was a time period where he was like, Tesla was about to go bankrupt if he didn't get a loan. If Tesla went bankrupt, would you call that gambling?
Yes, he did gamble because of the exchange of money. There was a money.
Right,
money
but now he's got a company that provides a product, right? And
So he
so,
won. He hit on the
right,
gamble.
and so you and I, who purchased part of that company, right, we will own some of that company, right? So again, I don't think I think the idea of gambling is also a function of what's going on inside the mind, right? So if you approach the game as a gambler, like I know a lot of people who approach the game as gamblers, right? They get gambling out as the outcome, right?
Gambling results.
But like I don't think Warren Buffett is a gambler, right? Warren Buffett does his research, right? And again, this is like the people, the random walk proponents, they kind of don't agree with this, but you know, Warren Buffett, what he did, right, is that he studied the price of assets, like stocks or businesses, and he would purchase a company whose price was below its intrinsic value, right? Okay, meaning that if like the building, right? If the intrinsic value of this building, of this mansion here, is $1 million, right? And somebody came by and like, you know, and we cut a deal at $500, right? You know, that person would have purchased this property below its intrinsic value. Would that be gambling on his part? Right, now Warren, that would pretty much be buying an asset at a discount, a major asset. Now, would it be gambling in regard to will the Buffalo downtown area come back, or is it coming back? I mean, that could be. Right? I mean, there's no guarantee, as we said, there's no guarantee that real estate prices always go up, right? But there are educated guesses. Technical analysis is a way to mitigate from that, right? Is that it can help you determine when to purchase a stock or when not to purchase a stock. We have no control over the market. So you and I sit here, right? The only thing that you and I can control, and this is also true at the casino,
Is our education.
education and money management. If you go in there and you say, I'm gonna spend $20, if you go to the casino, or $100 or $200, right? And you stick to that, right? That's good money management, right? If you go to it, then you like, oh, you hit 200, you're like, oh, I was that close, I was about to make it. You go to ATM and then go from 200 to 400, that's poor money management. Now, all that chance that was in the casino, again, that's on the casino, right? but you control money management. And so I think that's the same thing, that is also true in the stock market, buying financial assets.
Yeah, and I would absolutely say, decrease the gamble with knowledge.
No doubt.
Educate yourself,
Yeah.
learn, whether it's in the casino and it's the game that you're playing, the more skilled you
Yeah.
get in that game, you're decreasing the gambling component behind it, the chance behind it, and it's the same with the market. So learn the market, learn the companies that you want to invest in, but that's
Or trading,
That's
or trading.
fundamental. Yeah, and
Yeah, or
trading,
trading.
that's much more fundamental than technical.
Yeah,
But educate yourself, period.
yeah, it's
That's why we're
educated, and that's why we're here, that's why we're here, right?
Yes.
Okay, so this is the S&P index. This is an index of stocks that are traded in the Standard & Poor's index. I think about 500 stocks.
S&P 500.
S&P
Pretty sure it's 500
Yeah,
exactly.
S&P 500, yeah. And so this index, right, so again, the debate is random walk theory and efficient price hypothesis, right? If you look at the screen here of the S&P, this is a screen that shows the trend, right? And the trend, I didn't bring my glasses here, but the trend, like from here, like this right here, this is the Great Recession, right? 2008 to 2009, and it reversed in 2009, and then with all of the quantitative easing. You know what quantitative easing is?
Adding a lot of money into the economy.
Yeah,
From
so-
printing.
Yeah, so during the Great Recession, a lot of those big banks, they were saying that they were too big to fail, right? And so the Fed bailed out a lot of these financial institutions, right? So a lot of money came into the market, and as you look at it, this is all showing more money coming into the market. So let's say where my cursor is right here, at the bottom of the financial recession, is there any way to predict what's going to happen from 2009 to 2022? And so what is on my screen is that the market did this, and let's say this is 2009. Based on historical precedents, do we have any inkling with regard to what's going to happen from 2009 until like today, 2023?
So what's your belief as the answer to that question? Me being your student, I love to hear.
Well, my belief is two things on it, right? Because again, I'm an economist, so I would always say on one hand is this, and on the other hand is that. On one hand, it is a random walk theory, right? And on the other hand, there are trends, like so. For example, like we as economists, right? We do follow trends. Like again, our data, like when we talk about a business cycle, the business, say that we have a boom market, the economy's in a boom period or it's in a bust period, right? Or it's in a recession or it's booming. And so, like if it's in a recession, the data that we're looking at is like we had 2 continuous quarters of negative growth, then we're in a recession. It's looking backwards. But can that data, so if we did have a recession, right, history does tell us, right, that over the history of capitalism, that a recession has been followed by a boom.
Right.
So that's historical precedence.
Right.
Now, the pandemic, right? There was no way for in 2009 to predict the pandemic, right? And its impact on the market, okay? So in that context, or the radical change in industries.
Even though we weren't able to predict the pandemic, in hindsight, did the market reflect what the trends predicted, or no, was it completely off?
Well, so I think that after every recession, the market comes back, and it's proven that for the last 200 years at least, right? So people are talking about this recession, right? And that over when this recession is over, the market's coming back. So, like, for example, so the random price hypothesis, the random walk proponents, right, who talk about, efficient market hypothesis. They would say that when it comes to putting money on the table, right, to like Little Rapid, right, it's what would determine the decision, because we can't predict the future, is what is your risk tolerance. Alright, so like, how much are you willing to risk?
Yeah.
You can't predict the future, right? We don't know if there's gonna be another pandemic, we don't know if there's gonna be a war, right? But how much are you willing to put on the table, knowing that there are decent odds that if you invest in financial instruments, securities, bonds, options, what have you, derivatives, right? That if you invest in those or trade those, particularly investment, right, that they will have a higher value sometime in the future. It's like, what is your risk tolerance? How much are you willing to risk on that? Because we don't know. The cyclical, those who produce the technical, so it's kind of like we've got technical analysis, right, who says, the analysts who say that the market, right, prices and volumes, everything is baked into those price and volumes, both that which is known and that what is not known, right, that's in the price. And that history tends to repeat itself, right? So again, if we looked at this, right, so going back to this crash right here, the big question is, okay, we know that capitalism, unless it's, I don't know what's the term where it'd be so catastrophic. Contagion, this is a contagion, right? But by and large, assuming that capitalism stays as a system, right, it's coming back. And generally what happens, it comes back through industry or segmentation. So the leaders of the last bull market, there's gonna be a new set of leaders. Like, so for example, now, who are the new leaders? I'm thinking it's gonna be the AI, right? I think that this whole new bull market is gonna go with AI, probably crypto.
So the new leaders will be the young people in the tech industry, or
No, the technology, right?
the technology
Right.
itself?
Yeah, the technology itself, right? So, like, for example, what led the dot-com era, right? There was a whole group of stocks.
Copy,
Right.
yeah.
Right, and then they led to that boom, right? Then you had the housing boom, right? So there's always this industry rotation, right?
And AI is the next one.
And it might be, I don't know, right? But it seems like it, right?
I feel it.
Right, But yes, so I would say that historically it has come back, right? And when you look at the charts, right? Again, this is a longer chart. I'm not going to break down. If you want some more information, it's an email at cigbuffalo@gmail.com. If you want us to break this down even more, right? But if you look at the chart, there's definitely a trend, right? At the end of 2009, right? Somewhere along these lines here, if you made a decision to invest, right, and stayed in the market, right, you had a downturn right here, if you're following my cursor, right? And then let's say we go all the way up here. This right here is the 2020, the pandemic bear market, right? You see it go down, and then look at the rebound. Now, so that's the big question. Who could have guessed that the rebound would be so extreme, right? Now, I guess some people could have, right? If people were really able to correlate between that quantitative easing, all that money that was dropped into the economy, well, that money had to go somewhere, right? And so a lot of people are talking about inflation right now, all right? And you and I, as retail people, as everyday, as Main Street people, we tend to see the inflation in forms of the goods and services that we're buying at the malls or the supermarket or what have you, right? Target, But there was also inflation in the assets, right? So, like a lot of these assets, you know, like these multi-billionaires, right?
They just got richer.
They just got phenomenally richer, right? Just phenomenally richer. And they got richer because of that asset inflation. So going back to, is there a way to beat the market, right? Michael Saylor, right, who talks about Bitcoin, he's like, what rich people do is they buy and hold. They buy an asset that they feel is going to be an asset that will last a lifetime.
That's the Buffett model, I believe as well.
Yeah. And so, but, you know, I think that, you know, like we do want to trade, right? And there are examples of traders who have made significant amounts of money, right? So, you know, I think we're getting close to we've got a few minutes left, right? But again, as a being to my heart as an economist, on one hand it could be this, on one hand it could be that.
Yeah, so you said that earlier, and it made me think about something that fellow podcaster, my brother Jesus Negus, or as you know him, Sherman from the Academy, he says two things can be true at the same time. And then also in hermetics, you know, every truth is but a half truth. So that being said, me realizing that, I tend to take on the truths that I believe will serve me. So
Yeah.
which one of those truths do you feel like benefit you personally the most? And I'm assuming that it's technical analysis does work because you study it, you implement it, and you teach it.
Well, it worked for me.
Right.
Right, it worked for me. Going back to why I'm actually studying it, implementing it, and teaching it, is that it was my entry into, well, it was part of my entry, like as what I mentioned before in one of our past podcasts, is that, you know, as an economist, I wasn't really even looking at finance, right? And then I remember during the dot-com era, right, I had a student who was, he had bought some stock at a nickel. That stock went up from a nickel to $1, right? In this time period, right? He was like, Doc, this was like September of 1999. I was on my sabbatical leave, right? And he's like, Doc, you need to buy these stocks. I can't remember the tickers on them, right? But at the time he was telling me about it, they were about 5 cents. He told me about 5 cents. They went up to about 25 cents, and he was like, you know, and he was like, he had like a 3.8 average. He was on it. He was on it. He was on it. He was one of our best students, right?
He was a Javier.
Yeah, definitely, right? And so it went up to 25 cents, and then September, October, November, right? It went up to about $1. December, January, it went up to about $5. Right? It went from a nickel to $5, right? And then it went up to about $10, right? And it went up to $15, and then I'm paying attention. I'm like, yeah, this went up to $15, right? And then, you know, but I really knew nothing about this, right? I mean, people talk about the millionaire next door, right? There's a lot of people, because when the markets move, right, like that big move we saw from 2009 to 2020, right? People become millionaires just by having money in the market, right? And not having any skill with regard to the market. The downside of that is that when the market crashes, they don't have no skill to respond to the crash either. Right? But anyway, so, you know, he's telling me this, and, you know, but I'm seeing my retirement account going up, and then there's the greed, fear of missing out, right? The FOMO, right? And so everybody's making money, and it's like, it was just like a lot of fraud, right? It was all this fraud, and so it went, those particular stocks, they were moving about the same pace, right? Small tech, biotech companies, I think they were, right? And went up to about $20, and, you know, then $25. And finally, like when it hit $26, right, I'm like, I'm in. Right? I'm part of, what was that, Show Me State, was that Vermont, right, or New Hampshire?
You bought high?
Yeah, well, I didn't know that. See, but that goes on the random walk there. I didn't know that I bought high, right? So I bought at 11 o'clock in the morning.
Nice learning lesson.
Oh my God, I bought it at 11 in the morning. Got back to my office, right? By 1 o'clock, it was down to 22. By 2 o'clock, it was down to 17, right? All in the same day. I was there.
All you newbies.
Right, for all you newbies,
Buy low, sell high.
but if you could tell, right? You know, it's kind of like the greater fool theory, right? Who's the greater? Because on every trade, both sides of the trade think they're winners, right?
Right.
So, right, both sides of the trade thinks they're winners, right?
Typical of gamblers.
Yeah, you know, but again, not everybody's, I mean, I think there's the house always wins.